Our panelists today are Dr. Tami Boulder and Howard Krieger, and they are going to talk with us about the impacts of COVID-19 on business valuations. So with that, I will pass it on to Dr. Boulder, Tami, and you can take it away.
Great, thank you. So I am Tami Boulder. I'm a director in the Northeast Ohio office of CBIZ Valuation Group. I've been doing valuations for over 15 years, and I specialize in valuations for estate and gift tax, mergers and acquisitions, and also litigation support as well. And I'll let Howard give a brief introduction as well.
Hey, thanks, Tami. Appreciate it. Howard Krieger. I lead the New York City office for our valuation practice. My background is split pretty evenly between banking and valuation. So I'm mostly in the area of complex securities and transactions, but also have plenty of BVAL experience myself. And before coming to CBIZ, I was with KPMG, and then also I was with Witham Smith Brown. And then again, happy to be here. And thanks again, everyone, for the time this afternoon.
Okay. All right, before we get started, we'll just give you a little background on CBIZ Valuation Group. We are a national firm and a full-service valuation advisory practice. So in addition to doing business valuations, we also have folks that can perform real estate valuations and tangible property valuations, machinery and equipment valuations as well. And we have offices located in several major cities across the US, and we have approximately 100 people in our national valuation practice. All right, so our goal today is to provide some insight into the impact that the global pandemic has had on valuing businesses. So this will not be a primer on valuation methodologies, but rather a discussion of the current trends that we are seeing in the market and some issues that you will need to be aware of if you have clients that need to have a business valued in the current environment. So I know we've all been watching the news, but just to kind of set the stage for the discussion, here is a timeline of events. So the first case of COVID-19 was confirmed in the US in late January, and the US declared a public health emergency shortly thereafter. Now, the CARES Act, which is a $2.2 million stimulus package, was signed into law in March. And as of June, more than 1.8 million people in the US have been infected with the coronavirus. Now, states are now slowly starting to reopen their economies, and workers are gradually starting to return to work as well. So that's kind of where we're at right now. So when was the COVID-19 pandemic considered known or knowable, and why is this important? Well, valuations are performed as of a specific point in time at a valuation date. So professional standards require that the valuation expert only consider circumstances existing at the valuation date. So conditions that are not known or knowable at the valuation date would not be considered in the valuation analysis or discussed in the valuation report. Now, many companies perform valuations at year end. However, based on the timeline of events, COVID-19 and the impact on the economy was not known or knowable as of December 31st. Now, I know Howard will be going into a little more detail about the equity market. However, we can see from this timeline that the major indices did not reflect the impact of the pandemic until late February. So the general consensus is that valuations performed with valuation dates prior to the end of February would not consider the effect of the pandemic. Now, the AICPA recently issued a subsequent event toolkit that provides language and guidance related to disclosing subsequent events. So even though the valuation may be performed as of a certain date, the actual report is often not issued until a couple of months later. So the AICP notes that it is not a requirement to disclose a subsequent event in a report. However, the valuation expert has the option to do so if the information would be considered meaningful to the intended user. So this has some practical implications for litigation engagements, including domestic relations engagements. So since the value of a business can be drastically different depending on which valuation date was used, it also has important implications for estate planning valuations as well. And we'll touch on some of these issues, a little bit later in the presentation. So now I'm going to turn it over to Howard. So he's going to give a little more detail about the market response.
Sure. Thanks, Tami. I appreciate it. And just to kind of add on one of the things you mentioned, a lot happened over a somewhat compacted amount of time. And what that does is obviously provides challenges to the valuation professionals. What was known and knowable as of a given date when everything was changing week to week. But it also presents, an opportunity of sorts that, depending on what the purpose of the valuation is, the selection of the date itself could result in significant differences in what value you come up with. And so, in fact, even looking at the title of this slide where it says initial equity and debt market response, because when we wrote this slide, the circumstances were a lot different than just this past weekend when we went through and updated it. So initially, as was expected, access to capital tightened. Almost all private equity deals, were stopped. On the lending side, you had warehouse lines and folks that provide capital to like certain elements of the supply chain evaporating. And you saw basically a retreating to, cash until folks knew what was going to happen. And the relationship there is if you are valuing a private company, you have to look at the public company, what's happening in the public markets with those company values to kind of pinpoint that relationship. And so what ends up happening is, in good times, or even call it more stable times, the public companies tend to perform in a manner that is generally consistent with one another, where you could take a private company and kind of just plop it in there with your public comps. But the challenge in this market, of course, is where public companies within an industry itself start to move erratically or more wildly, and we'll talk about the impact on that in value a little later on. It creates a little bit more of a challenge to drop in your private company comparison. So with this initial response, buyers were expecting deeper discounts on transaction prices based on what they were seeing. And then sellers who now are in the position of, well, wait a second. I know the market is taking a beating, but as a private company, I know my relationships with all my vendors and my suppliers and my capital sources. And besides my projection being a little bit more uncertain, everything else is kind of status quo. And so the ability of a private company to make arguments as to why they are like a public company or not like a public company at this point in time are crucial in creating a reliable, defensible, and repeatable valuation. So the result of this sort of disconnect based on the individual company's experience in this market could be wider bid-ask spreads, or just putting a hold on transactions, right? Like, hey, we have an out, we're going to take it until things settle. And then investor perception tends to be influenced by shorter term guidance and events where value is really something that happens over a long period of time. And it's that perception, the variance in the perception between, gosh, things are immediately happening now that are hurting values versus, hey, long-term companies might be able to survive. And it's that perception and that market risk which could lead to, lower values or challenges finding a common ground or a meeting point. Next slide, Tam.
All right, great. So thank you for that, Howard. So now we'll walk through just some high-level considerations related to COVID-19. Now, we don't necessarily have answers to these questions, and there also isn't necessarily consensus within the valuation community of how these items should be addressed. But our goal is to just make you aware of some of the issues and give some insight into the impact that they may have on valuations. So first, how can companies make reasonable forecasts in light of COVID-19? Well, forecasting was a challenge for many small and medium-sized businesses before COVID-19, right? So now creating projections is even more difficult due to the uncertainty. Now, most companies will just use the best information, right, that they have available at the time to develop their projections. Now, for purposes of the valuation, client projections are going to require more due diligence on our part. So we'll be asking more questions, asking for additional support. So we've always done, kind of our independent review of client projections by looking at how growth rates compare to historical performance and industry growth rates. But just given the higher level of uncertainty, there will be some additional due diligence related to the projections on our part.
Tami, if I could pop in there.
Yeah, absolutely.
Like counterparty risk, I could think of an analogy here where, say, a year ago, if you were looking at like a shipping company, you get a list of, here are the people we contract with. And generally speaking, for the past 3 years, you can look at the behavior of the counterparties and go, okay, these folks are pretty consistent. But so not that we would take anything on face value, but perhaps the level that we kick the tires might be a little bit more muted when we see kind of consistent activity and counterparty exposure. Well, now, because we don't know the specific influences on each of the counterparties of the entity that we're valuing, we're going to be asking, or we have to ask more questions about who do you do business with and how well off are they? What's their situation? And all of that kind of the stakeholders and the sphere of influence around the entity we're valuing take on more meaning than, say, they would a year ago.
Okay, yeah, absolutely. Yeah, thank you for that, Howard. So moving on to the next question, how will paycheck loans and other economic incentives impact a company's ability to survive the pandemic? And how should these be reflected in the valuation? Well, the impact that the various economic incentives will have just kind of depends on the state the company was in prior to the pandemic, the industry the company operates in, and a host of other factors. Now, the proceeds from the economic incentives, they do need to be reflected in the valuation. However, some of the incentives include forgivable loans. So we'll touch on a little bit later how that may be reflected specifically within the valuation. Also, what will be the impact of short-term losses? And has there been a triggering event that might result in a goodwill impairment? Well, short-term losses would have a negative impact on the current value. However, it'll be important to get a sense of when or if the business is expected to recover. Now, for companies with goodwill in the current environment may prompt the need to perform an interim impairment test for goodwill. So the accounting standards provide a list of impairment indicators which need to be evaluated to determine if a trigger has occurred. So there may be supply chain disruptions, a shift in demand for a company's products or services, in addition to market volatility. And some industries may be more vulnerable than others. So some companies may need to assess if a triggering event has occurred like multiple times, as the effects of the pandemic unfold. Now, questions such as, when the economy will reopen and the availability of the labor force will just need to be evaluated, kind of based on the company's circumstances as of the valuation date. So as we mentioned, valuations are performed as of a specific point in time, and the conditions can change dramatically from one date to another. Now, also, as we mentioned, some industries may be more vulnerable to the effects of the pandemic than others. So grocery stores were impacted differently than restaurants, say, for example. So it's important to understand the outlook for the particular industry and how the company's outlook compares to that of its industry peers.
And Tammy, if I could
Yes.
add to that too, the makeup of the labor force is also a critical consideration. So,
Absolutely.
right, so in some industries, you may have like highly unionized labor forces, which kind of act on a collective basis relative to their employer, versus some industries where the employers have more of an at-will, makeup, and therefore the chunkiness of the rebound, which when I say chunkiness, or if we talk about things that create volatility, the more volatility, the more uncertainty, that increases risk. And so where two companies might have similar cash flow projections, if the risk around one is greater, then of course the value is going to be lower. And we'll talk about that a little bit more later.
All right, great, thank you. So what loss of business or relationships would be considered permanent? Well, any type of permanent loss would need to be specific to the individual company as well. But it'll be really important to raise this question with management just to get a better understanding, because it'll be important to determine what that impact will be of any permanent loss of business or relationships and how that will impact the cash flows. So what is the optimal capital structure or mix of debt and equity for the company? So perhaps more important is, what is the attainable capital structure given the company's current circumstances and also the sources of capital available to the company? So historical capital structures may no longer be reasonable. Also, risk-free rates have decreased, but uncertainty and volatility have increased. So it'll be important to consider any additional risk facing the company in the valuation, as Howard alluded to, and not just the mechanics of looking at market data and coming up with an optimal capital structure. Was there anything you wanted to add, Howard?
I was going to say, my dad used to have a saying. He'd say, "Hey, you know what the golden rule is?" And I'd say, "Do unto others, Dad." He goes, "No. He who has the gold makes the rules." And one of the, and so in this case, when it comes to the companies that are being valued, there is definitely a have-not disparity we're observing, where larger companies that going into the crisis were sort of tentpole clients for their capital funding sources, meaning they have a relationship with Chase or B of A or the big banks, or they're with the big PE firms. Those capital providers behind those big companies have a lot to lose if their portfolio investment starts to flag. And so you see a disparity in the attention being paid to the larger companies that these capital sources want to make sure they take care of. And then the smaller private companies, which a lot of our clients are, we talked about the paycheck program. Some of them got letters after they applied saying, "Hey, like literally you are lower in priority because you're not as big." And so the quality experience that the smaller companies have in the market relative to their capital source has to be considered in the valuation. And I'll tell you, Tammy didn't mention it, but I would think that from these slides, these are great questions to copy paste, drop into a doc. And as you have your own little file, right? If anybody on this call has a file where they're putting together some valuation, if you can answer these questions fully as it pertains to your subject client as of a subject time, you're going to be in great shape when you have to defend that value.
Yep, absolutely. All right, Howard, I think you're up next to start off our discussion of the valuation methodologies.
Excellent, thank you. And so this was the point we alluded to earlier, that value, right? Value is very simply a benefit stream discounted for the expectations around receiving that benefit stream. So I use a lottery ticket example a lot where, hey, if a lottery is paying out $400 million and there is a 1 in 200 million chance that you win the lottery, then that lottery ticket is worth $2 a ticket. Just the 400 million payout divided by your 1 in 200 million chance of winning. Now, obviously, those aren't the only considerations as it pertains to the lottery. And then, of course, with the business valuation, there's other things to consider also. But in this case, very simply, you have cash flow The more cash flow, the higher the value, and the more risk, the lower the value. And this little chart here I put in shows an example. If we imagine that blue vertical line is, in our example, our best guess of what revenue for our company is going to be like in 2020. I think our company is going to make $500,000 in revenue in 2020. Well, we know that's just a guess, and we know there's going to be an error associated with that guess. Now, you can't earn less than zero. You can't generate less than zero revenue. And you could generate, in theory, an infinite amount of revenue. Who knows? Maybe your product becomes the next Cronut or Furby or Cabbage Patch Kid. So you have your estimate, and then you have a distribution around that estimate. That distribution, in this case indicated by that green hump, is the error. And the fatter that error is, meaning the more uncertainty I have, the greater the risk and the lower the value. So the projections that were made prior to COVID really sinking its teeth into our economy may still be valid for some industries. They may look at what's happening and say, well, you know, all of my upstream suppliers are in good shape, and all of my downstream buyers, the Home Depots of the world, the Lowe's, maybe you're creating some sort of manufactured product like Windows. Windows are always a good stable thing in good times and bad. That projection may still be valid, but the risk around hitting that projection gets wider, and that then lowers the value of the company. So projection amount and risk, those two elements create value in all methodologies selected. Go ahead, Tam.
Okay, that's great, Howard. Thank you. And as Howard mentioned, value is a function of cash flow and risk. So for companies that have seen decreased valuations due to the impact of the pandemic, they may be wondering, you know, as the economy slowly starts to reopen, how they can try to increase value in the future. Well, they need to focus on both sides of the equation. So business owners are often just focused on cash flow, but they also need to reduce their risks. So things like trying to diversify their supplier relationships, you know, having a strong management team so that the business is not too dependent on the skills and network of a single owner, can also help to increase value. Also, are there financial controls in place? You know, does the company have adequate financial reporting? You know, all of these things can go a long way towards reducing risk and building value over time as we come out of the pandemic.
And Tammy, a good way to lower risk, right, is, or to assess whether the client has lowered their risk would be to ask them point blank, have you spoken with your suppliers? What are their challenges? Or if you're like in a business where you have contracted takeouts, have you spoken to the parties that contract for your services? Like maybe you supply, going back to our Windows example, maybe you support one of the local builders. It's talking to the local builder and saying, hey, are you still building these 100 units? Yes, check the box. And so it's almost like the behavior of management as it pertains to just shoring up the projections in itself reduce risk and raise value.
Yeah, absolutely. Great point. Thank you. All right, so now we'll move on to a discussion of the various value methodologies. Here are the three common valuation approaches. So the income approach is based on the present value of earnings and cash flow, and the common methods under this approach are the discounted cash flow method and the capitalized cash flow method. The market approach is based on market prices or multiples from market transactions involving the sale of comparable interests. And then finally, the asset approach is based on the economic value of assets and liabilities. Now, for our discussion today, we won't spend much time discussing the asset approach. So this approach is typically used for holding companies or companies where the value is derived more from the assets held than the company's ability to generate revenue. So we'll mainly focus on the income approach and the market approach for today's discussion. Now we're going to start by taking a deeper dive into the impact of COVID-19 on the income approach. So this approach focuses on earnings, growth, and risk. So for companies that have experienced disruption to their operations and short-term losses, the effect has been a reduction in both enterprise, and also shareholder value. Now, when we perform a valuation, we review the overall economic environment because things like inflation, interest rates, unemployment, they pretty much impact all businesses in some fashion. So to the extent that the economic landscape is changing, it's important to assess the impact of all of these factors, as of the valuation date. So the discounted cash flow method under the income approach is a multi-period model. Now, where the cash flow is projected over a 3 to 5 year period and then discounted back to a present value. Now, this is our preferred methodology because the analysis can then be tailored to the company and each year can be adjusted for anticipated changes. Now, forecasts are critical, for this method, as we discussed, and management's forecasts are going to require a higher level of due diligence. Now, typically, management will use the prior year actuals as the starting point for their forecast. However, because of the disruption in the first quarter of 2020 and the uncertainty going forward, those historical results may no longer be valid. Also, any projections prepared prior to the pandemic are probably no longer valid as well. So instead of preparing one forecast, management may need to consider multiple scenarios that show revenues and cash flow maybe staying flat and then also increasing or decreasing. So for purposes of the valuation, the different scenarios can be weighted based on the expected probability of each scenario. Now, obviously, there's some subjectivity, in that process, but at least it will help document that all of the various potential outcomes have been considered. The analysis also includes a terminal period that represents the value into perpetuity. So it's important that the terminal period reflect normalized cash flow. So it's okay to reflect year-to-year changes in the initial 3 to 5 year discrete period, but over the long term for the terminal period, that portion of the analysis really needs to reflect just normalized cash flow and margins in that portion of the analysis.
Hey, Tammy, can I ask a question real quick?
Sure.
So I know a lot of times when folks, maybe smaller companies or less sophisticated management teams are putting together projections, oftentimes they'll just say, like you said, take the historical, roll it forward 1 year, and then rely on the appraiser to do what we call like a single period capitalization model. In this case, it almost seems like for 2020, single period capitalization models might be off the table. And if people maybe only have a 2 or 3 year projection model, would we be expecting folks to have to push that out to get to stability before doing a terminal period calculation?
Well, it really depends on, I think, the company's circumstances and what their business looks like. So for some businesses, they may be able to get to a more stabilized period in a year. So for other businesses, it might take a little longer. So, and I agree with you with regard to the capitalized cash flow method. That is going to be very difficult to just settle on 1 year and kind of push it forward from there. But I think it's really going to depend on the circumstances of each company. I mean, that may be harder for some companies than others. So I hate to give you that kind of an answer, but I really think it just kind of depends.
I'm used to that answer. Depends.
All right. So the cash flow should also take into account the impact of Paycheck Protection Program loans or similar incentives. Now, there is no consensus on how the forgivable loans should be reflected in the cash flows. However, one way to reflect the PPP loans is to estimate the value of these incentives separately and then kind of show it as a bolt-on or an amount that is added to the value. So this kind of seems to be a popular approach because that way it's separate, it's easy to see how it's accounted for in the valuation and it's easy to see the impact because for the most part, these are going to be kind of non-recurring type of cash flow proceeds that the company is going to be receiving. Now, it's also important when companies are, developing their forecasts, they look beyond the income statement because many companies will emerge from the current pandemic with less working capital because of declining cash and also accounts receivable. Now, again, this is going to be different for different companies, but when they're coming up with projections or just thinking about how the business is going to look in the future, it's also important to consider the balance sheet in addition to the income statement. Now, similar to our discussion of the projections, the projected growth rates will also require more diligence to make sure that they're reasonable. So there's going to be variations in industry growth rates due to COVID-19. And since a business valuation considers the value of cash flows into perpetuity, it's important that the estimate of the long-term growth rate is reasonable. Now, the general consensus is that companies cannot grow at a rate that's higher than inflation over the long term. And since the terminal value is often a significant portion of the value, it's really important that the long-term growth rate estimate is not too high or too low. Now, this slide just reflects some of the various rates that are used to estimate the long-term growth rate. So as you can see, the rates have generally kind of ranged around 2 to 3%. But I just want to mention that the Federal Reserve Bank of Philadelphia will be publishing an updated projection of the 10-year projected inflation and also real GDP. So that'll be coming out on June 12th. So it'll be interesting to see what that new estimate, that new long-term growth estimate will be.
And Tami, I'll add this. So
Sure.
in talks with economists and review of material, that Goldman Sachs did a presentation May 27th with a lot of great data in it, and that's publicly available. The kind of the consensus, or rather maybe the intuition is the Fed has put all this money out there that it would seem to imply that inflation is a foregone conclusion. But what's interesting is a number of economists have come out and said that the flush of cash flow in the market might actually create deflationary pressures. And so where you'd expect maybe some of the percentages you're showing to pop up on the June 12th, I wouldn't be surprised if Philly comes out with something in line with where the inflation has been, because of, again, this uncertainty, right, of, hey, a lot of folks think we're going to have a deflationary period, and then a whole bunch of other folks think we're going to have an inflationary period. So what they put out as their best estimate is something in the middle. There's just a lot more error around it.
Mm-hmm. Right, I agree. So it'll be interesting to see what comes out. All right, now, in the discounted cash flow method, the future cash flows are discounted back to a present value at a rate that reflects the risk of achieving those cash flows. So that rate is also known as the cost of capital. So in coming up with this rate, we look at market risk-free rate, which is extremely low right now. So it's about 1.3%. So a lower rate equates to lower risk, which in this environment doesn't really make sense. So, however, the equity risk premium may increase, which would help offset some of that. Now, we've already touched on some of the issues with the cost of capital, but I just want to mention that while there may be a tendency to increase the discount rate to reflect additional risk, it's important not to double count the risk. So if the cash flows have already been adjusted to reflect risk and some of the issues surrounding the pandemic, then a substantial increase in the discount rate may not be necessary. Now, when a valuation is performed, the valuation expert will do an assessment of the company's specific risk. So in addition to any factors that may relate to the pandemic, here are some of the factors that would be considered in this assessment. So typically depth of management, customer concentration, geographic diversification, these are some of the main issues that we're looking at. So as I just mentioned, if some of these risks have already been reflected in the cash flows, then it would be important to be careful not to double count them when we're adjusting for this company specific risk. Now, the second method under the income approach is the capitalized cash flow method. So under this method, the value is based on a single year of sustainable earnings. And the baseline for this analysis is typically normalized historical performance, as Howard mentioned previously. So the primary assumption under this method is that the historical performance is indicative of expected future results and that growth and cash flow has stabilized. Well, as we talked about, in the current environment, it would be difficult to make the argument that growth and cash flow have stabilized, especially at this point. Now, sometimes this method is used if management doesn't prepare projections, as Howard mentioned. However, this method would not capture any short-term growth or decline. So, as Howard mentioned, one option may be to, management may create a one-year budget or projection, and we would help them project out from there. But in this environment, it's probably better to just maybe sit down and work with management and have them come up with a projection just to the best of their ability, based on the information that they have available. Because just doing a single capitalization of a single year's results just may not provide accurate results in the current environment. Okay, and with that, I will turn it over to Howard, and he will give us a little more detail about the market approach.
Sure, Tammy, thanks. So the market approach is just like it sounds. It is using market indications of value to create a syllogism, if you will, for your own company that you're valuing. It's no different than if you look at the prices of houses. What do you tend to do? You look at other houses that have recently sold, compare how many rooms, bathrooms, pool, no pool, compare it to the subject property, and you can draw some comparisons that way. So, one way to think about it is if you see in the public market companies that have, X earnings and Y profit margins have Z value, then you could look at the relationship of the value you're observing to the cash flow that was recorded in terms of margin and say, okay, let's say this company is valued at 2 times revenue. Well, then I can look at my company and say they're a lot like this company that got valued at 2 times revenue. So my company is worth 2 times revenue. Public trading multiples and private transaction multiples, however, are not impacted by the same day-to-day pressures. So while it's very common, and if I'm at a party and someone wants to talk values with me, the first thing they'll do is say, hey, so-and-so is trading at 3X, 4X, etc. That's all well and good, but unless you unpack how the multiple that's observed in the market is derived and how it compares and contrasts with your own company's economics, then the number that's observed in the market may not be relevant. The other thing to consider is the drop in public multiple may not mean immediate drops in private multiples. So a lot of the activity that we see in the stock market over the past 60 days has been a battle between people that are betting for a recovery at a certain pace and people betting against recoveries at a certain pace. And so the noise in the stock market, its huge crash, the fact that it touched all-time highs last week in certain cases, a lot of that noise and rigmarole have nothing to do with any of the fundamental value drivers underpinning a business's values. And that makes drawing that comparison between, say, a private company that you're valuing and a public comp even more distance. And the other thing, too, is that the public market recovery may not equate to private market recovery. If you see, Applebee's stock shooting through the roof because a number of states have decided, hey, let's open it up and start serving, that won't help when you're valuing, say, the local pizza joint or the mom and pop franchise chain of a couple of stores in a state or a geography that is currently in lockdown. Next slide. Cool. So the Guideline Public Company Method, the GPC, uses market indicators such as stock prices and the business enterprise value to EBITDA. In the first quarter, we saw those values drop because the public companies all dropped. And while lower market multiples suggest a contemporaneous valuation being lower, you really need to lean on like the income approach like Tami was talking about, and the values should reconcile. Just because you pick a different approach doesn't mean that you should come up with a significantly different value. The two, in an ideal world, all approaches would get you back to the same valuation. So if you are looking at your income approach value using forecasts and discount rates, and they're wildly off what's implied by using the guideline public company method or a market approach, then you have to ask yourself, what gives? Am I double counting the risk? Am I too optimistic or pessimistic on my forecast, or are my public comps not really all that comparable anymore? By late Q2, for instance, a number of industries have come back to pre-crisis levels. A lot have not, but certainly a lot have. And ample liquidity is a key point here. If your client relies on some sort of backstop of capital from their bank or the US government, find out what bank they're using, because larger banks, larger balance sheets, probably have more flexibility to work with a client than, say, a mom and pop working with a local bank who themselves are now struggling to figure out where their capital is going to come from. Next slide, Tam. The guideline public company method, during times of disruption, there's a rationality. The negative impact of their stock price may not reflect the actual impact of the pandemic. I'm sure a couple of weeks ago when everyone was talking about the food plants shutting down, Tyson's is publicly traded. There was that knee jerk, let's pull all the money out, throw it into treasuries, which I'll tell you right now, the sell-off of the stocks, people got to put their money somewhere. So where do they put it? They run to treasuries. That causes those interest rates to drop. That's exactly the number we use for our risk-free rate, which would imply your private company value to rise. So all of those moving parts need that reconciliation. And then practical implications. Maybe using a forward-looking multiple would produce a more reliable value than using a multiple in the current period. And so you may want to actually apply a multiple to your subject company 1 year out after they've gone through that step that Tami talked about of figuring out what will their income statement really look like in the kind of after things settle and people start getting kind of more in line on how they behave, how they transact, what business they do, etc. All right, Tam, next slide. The guideline transaction method is based on multiples from transactions that could be both public and private. Now, the transaction multiples, in all likelihood, that you see today, except for maybe a few that you might pick up in February, March, April, for the most part, transaction multiples are coming from deals that were negotiated, say, 6 to 8 months ago that closed 3 to 6 months ago. And so none of those multiples would incorporate the level of, call it, realized risk that the virus ultimately produced. Now, that does not mean that those transaction multiples were devoid or absent consideration of risks related to any number of things, terrorist acts, global pandemics, financial crises, etc. I think that if you think about that distribution around that best guess, there's always a factor for the wheels falling off the wagon factored into the valuation. But what we as practitioners need to do and what you should expect from your valuation providers is just a greater consideration of the realization of that risk. And in a way, we're actually better at measuring the impact from the risk because we're living it, right? We're living in a time of great uncertainty. This is the time you hit record and remember all the stuff that happened so that, God forbid, we have another situation like this a few years down the road. Instead of just knee-jerk turning dials and knobs to see, hey, what feels right, we can actually look back on our prior experience and carry that forward. But in this case, questions of what period should the multiple be applied to? What period should the multiple be derived from? Or do you just say, hey, you know what, transaction multiples, I'm just going to put them in a little box, ribbon, shelf, and rely on other methods until the market stabilizes? Anything to add there, Tami?
Yep. Well, I would like to add that, depending on when the valuation date is, and whether it's year end, first quarter, or second quarter, the value under the market approach could be very different. So some valuation experts are proposing that the guideline transaction method be excluded altogether. However, I would caution against that. I think it's important to look at the value from different perspectives, and multiple approaches should be used just to help mitigate some of the drawbacks of the individual approaches. Now, it may be that the methods should be viewed with increased skepticism and maybe less weight is ultimately placed on it, but I think it's better to have more information than less, and I think all methods should at least, be considered. All right, so now I'd like to just touch on some of the issues specific to litigation and family law. So first, what is the valuation date? Well, we discussed earlier in the presentation at what point COVID-19 would be considered in the valuation. So the parties should agree to the valuation date up front with the understanding that one valuation date might result in a higher value that would favor one party, while a different date might result in a significantly lower value that might favor another party. So you need to keep that in mind. Also, who prepared the projections and for what purpose? So were they prepared by the business owner's spouse specifically for the domestic relations proceedings, or were they prepared by the owner to submit to the bank to apply for the loan? These could potentially be very different sets of projections. So it's important to understand the context, with which they were prepared. Also, do the projections show the business recovering after 1 year, 2 years, 5 years? And is it reasonable? What support is available for the projections? We all know that, the forecasting and projecting is going to be a challenge, but there should be some level of support behind the numbers. So, if the projections are overly optimistic, they may overstate the value. And if they're overly pessimistic, that might understate the value. So you need to be aware of that. And then also, how is risk accounted for in the valuation? So as we mentioned before, if risk is reflected in the cash flows and the discount rate was increased significantly, then it's possible that risk may be double counted, which would understate the value. Now, if transaction multiples were used, were they applied to a historical period or a future period? The result may favor one party versus another. So it's something that needs to be considered. And then finally, it's important to understand the methodologies used and how they were considered in the final conclusion of value. Did they consider all methods? Did they place, all the weight on one method or, all methods? How did they come up with the final conclusion? And then finally, we'd like to just touch on some of the unique estate planning opportunities resulting from the COVID-19 pandemic. So values are lower and there are historically low interest rates. So now may be a good time for individuals to make transfers to family members or trusts. Now, in addition, transfers of minority interest would generally be able to take advantage of valuation discounts, which would lower the value even further. And the current level of estate and gift tax exemptions is very favorable for making transfers of assets. Now, executor has the option to use an alternate valuation date that is 6 months after the date of death. If the values have declined during that 6-month period, using the alternate valuation date can also help reduce the amount of any estate tax that might be due. And then finally, the historically low interest rates can create additional savings for transferring assets. So the applicable federal rate, or AFR, for obligations of 9 years or more is now just over 1% as of June. So that presents an opportunity as well. So now we discussed briefly the application of valuation discounts for minority interest. So now I'll turn it over to Howard to discuss these discounts in a little more detail.
All right, very good. So the first questions you have to ask yourself is, does the subject interest have control of the enterprise? If it does, then your value result's going to be a controlling interest value. which is going to be your highest value. If they don't have control of the enterprise, then the question becomes, is the interest readily marketable? And so you are already in a situation where you're going to have a discount for lack of control. If that non-controlling interest is readily marketable, you'll have a marketable minority interest. And if that interest is not readily marketable, then you end up with a non-marketable minority interest. And that non-marketable minority interest is the lowest of the value in that, the choice of the three there: controlling, marketable minority, or non-marketable minority. And so how's a discount for lack of control determined? Well, there's a variety of methods to do so. There are studies done using public traded stocks and how they are valued before and after the transaction. There are also other studies that have been performed using private companies to see if what is the value of control, and the factors that would affect the DLOC. Offhand, I could think of, well, how well does the centralized decision making impact the bottom line of the company? So if I run the business, I get to choose how I fund the business, and the capital structure may be important. If I have aggregated authority and I can make decisions about vendors I choose or other decisions about the disposal of the entity, that would itself lead to a greater value associated with control. Tami, before I go to DLOM, were there any other factors you wanted to discuss as it pertains to DLOC determination or its impact?
No, I think you hit pretty much all of the highlights there. So thank you.
So then going on to the discount for lack of marketability, I think about the discount for lack of marketability as almost being the hedging cost, meaning if I knew I wanted to sell today and I have a pretty good idea of what the thing I want to sell today is worth, then the DLOM is in effect the cost it would run me to lock in today's value while waiting for the sale to close. And there's a couple of ways DLOMs are calculated. One, in the litigation setting, I think about the Mandelbaum factors, where there are like 20 factors you think of as to whether or not the marketability is increased or decreased because of these 20 traits. Practitioners also use complex Asian put or protective put models to come up with what the implied cost of the risk of the value of the company or subject interest dropping over a specific time period. But suffice to say, well-documented understandings of the drivers of these discounts is a must, especially in this market, especially with the already depressed values, and avoidance of double counting when you layer these things together is also of critical import. Does the global pandemic impact DLOC and DLOM? Absolutely, and it changes over time. So if your valuation date is in that first week after like the US basically locked everything down, you can make the argument that there really was no market at that time, or the market was very, very, very constricted. And so on that valuation date, you might see larger discounts, as opposed to even now where things are starting to loosen up and ungel, and certainly not at year end where things were just hunky-dory, normal as they go.
Now, I'd also just like to add the discount for lack of marketability. It's also kind of a function on the restrictions that are in the company's operating agreements as well. So, are there restrictions on transfer? Do they allow for distributions? And if so, does the company have the capacity to pay distributions, and have they been paid consistently? And then also just looking at things like the holding period. So it's really important to also just, understand the specifics of the company's operating agreement. We're looking at the DLOM as well. All right, and finally, just some final thoughts as we get ready to close here. So what is the condition of the industry in which the company participates? So as we've mentioned, a lot of the the impacts of the pandemic are going to be specific to the company, and the specific industry, that they're operating in, and has the risk been appropriately accounted for. If it's reflected in the cash flow, then you have to be careful not to double count the risk and have it, a significantly high discount rate as well. And then also, it's just helpful to have an awareness of the strengths and weaknesses of the various valuation methods, what the analysis looks like, what the inputs are, and how the various issues related to the pandemic are reflected in the various valuation methods. And then also, as we mentioned, there's just, some skepticism related to the market approach during times of economic uncertainty, just because of, the volatility in the market. And as Howard mentioned, as far as transactions, when exactly were they negotiated and what effects are actually reflected in the transaction multiples that we're seeing. Is there anything you'd like to add, Howard? Any final thoughts?
Value is a single point representation of a lot of guesses about a lot of activity over an undetermined future length of time. Value is a single point of a lot of future stuff. And so think about time, think about how things unfold and all that uncertainty. We certainly are responsible for documenting what we think would happen, but that's really the key.
Great. Sounds good.
Okay, well, thank you both very much for a really interesting and information-packed session. We're going to give it a few seconds here. If anybody has a question for our panel, now is the time. You can use the Q&A function or enter it into the chat. And if I don't see any, we'll wrap it up. But again, thank you very much to both of our panelists. Really fascinating. And I am going to post this on the CMBA YouTube channel later this afternoon. So if you'd like to review any of the topics that were covered today, it will be there where you can view it and share it. So seeing no further questions, I'm going to thank all of our participants, and we will move on and have a good day.
Great, thank you.
Thanks again. Bye-bye.